In a country whose central bank's decisions have been boring everyone for decades because they kept interest rates near zero, suddenly deciding to change everything. Well, that's exactly what Japan's Bank of Japan is about to do on the 18th to the 19th of December 2025. And it might not only affect Japan, but gold, silver, stocks, currencies, and your investments, wherever you are in the world. Now, before you roll your eyes, this isn't dry economics. This is money in your pocket. What is this meeting really about? Japan's central bank, called the Bank of Japan (BOJ), meets regularly to decide monetary policy, interest rates, inflation outlook, etc. You can see the official schedule and minutes on the BOJ website, Bank of Japan. But here's the twist. For most of the last 30 years, Japan's rates have been near zero, basically free money. Now 2025 has been different. Inflation has been stubbornly higher than the BOJ's 2% target for more than 3.5 years. And markets now strongly expect a rate hike from 0.50% to 0.75% at this December meeting. This might seem like small numbers, but trust me, a tiny change in Japan can send shockwaves across global markets, especially because Japan used to be the world's cheap money hub. Why Japan matters, not just for Japan. Before, investors around the world borrowed money in cheap Japanese yen and then invested that money into higher-yielding places, like stocks in the US, India, Europe, and commodities like gold and silver. This classic strategy is called the yen carry trade. It's like borrowing on a 0% credit card and investing in something profitable. Sounds fun, right? But when the interest rate changes, that entire carry trade gets unwound. Fast. Now that markets expect a real interest rate hike, this carry trade goes into reverse. The yen has even started to strengthen recently, a sign that expectations are shifting. Impact on gold and silver. No boring charts, just real talk. Why gold could dip around the meeting gold doesn't pay interest. When interest rates rise, even slightly, the opportunity cost of holding gold goes up. That means some traders temporarily sell gold in favor of interest-bearing assets. That can push prices down in the short term. So if BOJ hikes as expected, gold might pull back first, because traders already anticipated it. But here's the big picture: gold isn't just influenced by Japan. It's influenced by global real interest rates, inflation psychology, currency weakness, and geopolitical risk. And guess what? Other major central banks, like the US Fed, have recently cut rates slightly, which can push real global yields down. Money control low real yields plus persistent inflation equals gold demand up. So even if gold dips initially, the long-term trend still points up because inflation isn't disappearing. Central banks are adjusting slowly. Gold is a global hedge, not just a Japanese one. Silver tends to be even more volatile. It falls faster but also rises faster, so it's better for tactical trading than pure long-term insurance. What about stock markets? Global markets. If the BOJ hikes as already priced in, markets might not crash. In fact, stocks could stabilize as uncertainty fades. However, if the BOJ signals more hikes beyond this meeting, or if the hike is larger than expected, we could see higher volatility, especially in tech and growth sectors that depend on cheap borrowing. Indian market. India's market is still strong in the long run. Businesses, consumption, tech, growth stories, all healthy. But here's the real talk. FIIs, foreign institutional investors, could rotate capital if global liquidity conditions tighten. That means short-term pullbacks could happen, but quality companies with good earnings and strong balance sheets will attract money again, so don't panic. Prepare smartly. What you should do, not financial advice, just real strategies. 1. Protect yourself. Don't react emotionally. Volatility spikes around big policy announcements. It's normal, but emotional reactions cost money. 2. Gold strategy. Use staggered buys, CP style. Don't buy all at once. Buy on dips. Think of gold as insurance, not a lottery ticket. 3. Equity strategy. Keep some cash ready. Avoid over-leveraged positions. Focus on sustainable businesses. If markets dip, don't panic. That's where opportunity knocks. 4. Currency awareness. A stronger yen can shift investor flows, especially carry trades. A weaker dollar combined with yen's strength could complicate commodity pricing. 5. Long-term mindset. Markets oscillate. They don't trend forever. Big winners are often the calm, prepared ones. Japan's meeting on the 18th to 19th of December is a policy moment, not a money apocalypse. The key is understanding the why, not just the what. Remember, short-term noise is normal. Long-term structure matters more. If you found this breakdown helpful, hit like, subscribe,